Hello and welcome to the Business Standard Morning Show. I'm Ishan Gera and here are the stories for the day. The IT services industry is slowly opening up offices after a lengthy COVID-induced hiatus, and employees are making a staggered return. But this time around, workers apprehensive about big change of coming back to their desks have raised a new set of demands. What do the workers want, and how are companies' HR executives navigating this? We look at both these perspectives in our next report.
For employees around the world, the onset of the pandemic and subsequent shutting of offices in March last year was beyond their belief. All of them wondered how things would work out. And now, over 19 months later, when things have actually turned out well, the gradual opening of offices is yet again posing a challenge before them. Some are raring to go back to the office, while others are preferring the comfort of home. The employers and the HR are also grappling with some tough questions. Will the transition be smooth again? Let us try to find out. With the COVID-19 infection ebbing, IT companies around the world have started opening offices. In India, IT firms are also following suit as employees are being called back to offices in a phased manner. A joint survey by tech industry body NASSCOM and job listing portal Indeed found that employees and employers are equally interested in returning to offices. But 40% of the employees expect to work from office premises only up to 3 days a week. It all has also triggered a debate about what is the best way to work and does working from home affect productivity. A large chunk of workers is now expecting a hybrid work culture where they have the freedom to work from both the places. According to the NASSCOM survey, hybrid work is the preferred choice of over 70% of organizations. The work from home culture has also helped employees save on traveling time and costs. Not just this, many also saved on rent as they moved from metros to their hometowns to live with their parents. Companies are trying to strike a balance between the needs of the employees and also those of their clients. From the company's perspective, a return to office will help manage critical business functions, maintain organizational culture, and data security. So, as the restrictions eased, Google announced a 25% salary cut for those opting to work from home, a step apparently taken to bring all the workers back to office. Most IT companies in India have also started calling employees back to the office. Companies also hope that it will reduce workers' ability to attend job interviews with ease, making it difficult for them to switch jobs. The IT industry is facing attrition rates as high as 30%. The IT companies have also saved a lot during the pandemic due to the reduced bills of electricity, internet, and that of transport. But they are also facing several challenges, including managing key business functions. Tata Consultancy Services, the country's largest IT services player, has told all its employees to be back at their deputed cities by November 15. TCS is encouraging most of its employees to return by the end of this year, before gradually switching to the 25/25 model, under which only 25% of its 500,000 global workforce will be in office at any point of time by 2025. Infosys has asked senior leaders to come to the office at least once a week. It is preparing to have a larger population come to office. Its COO Praveen Rao said the company is working on a model that provides flexibility to employees. 5 to 6% of HCL employees have returned to offices, while fully vaccinated senior staff at Wipro can come to work twice a week. According to the NASSCOM survey, 50% of the workforce is likely to return to offices for up to 3 days a week starting next year. But most IT firms have now said that their leaders have begun to travel internationally for client meetings. Specialist staffing company Exfinos co-founder Kamal Karant gave us some valuable insights into the thought process of IT employees and their companies.
See, in terms of employees' eagerness, you can say that eagerness is a rarity even under normal conditions, right? It's only become rarer now, especially under conditions where work from home productivity has been acknowledged and celebrated. So in a way, you can say, yes, a bit of eagerness and reluctance both exist. Eagerness a change point of view. Some of them sitting at home just from a change point of view want to come to office. But what we hear people saying is that if it's a kind of a full-time thing, have to come 5 days a week, that is not something that they would appreciate, because in their head, the employers have already acknowledged that they have been productive. So from that point of view, the eagerness is from a change point of view, not from a full-time point of view. People who are in leadership positions and people who have got used to the old templates of working from office, how they led their teams, how they created teams and make them productive. For them, this new template has not worked very well. So they want to see their employees back in office. So that is what the managers and the leaders want, whereas the people who are part of the teams feel that they've been productive, and forcing them to come back to office is met with a bit of a reluctance. Some of the leaders in IT industry believe that by allowing people to continue to work from home, it gives more opportunities for people to attend interviews from the backness of their home. Whereas if they're asked to come to office, maybe they'll be busy working or commuting. By coming and going, that there are lesser chances in the openness of the office to attend numerous interviews that they've been attending. I think organization, by forcing people to come to office, especially the younger generation who are reluctant to come, may not become so employer friendly, and possibly they will pick up jobs with companies who are a little more open-minded about remote work. And there is a strong view from employees that we are interviewing saying that I don't want to come to office to do the same job I did at home. Okay, if you want me to come to office, I'll come for a meeting, to meet a boss, or to meet all my team members together. But if you want me to come and code in the same office what I did at home, that is not something that I would like to do. So that's the overall opinion that's emerging. Getting people 5 days of work is something that HR is really going to struggle. But organizations and leaders believe that work can be more transformative if they come to office. Whether that is really true, or they'll simply add to the facilities cost, transportation cost, and stress of traveling to employees, time will tell.
Rituparna Chakrabarti, co-founder and executive vice president of staffing firm Teamly Services, said that work from home arrangement may not continue after the pandemic.
We recently did a survey, and it showed that 57% of the audience are saying that they are looking at a hybrid working model. I think there is no clear verdict right now, but there is one thing which is very clear, which is that there is a certain sense of depletion of social capital, and that is playing a big role in the mind of both individuals as well as employers per se. People did not have much options, honestly, but to work during the pandemic, right? And to make long-term plans and strategic changes based on that, based on the fact that during pandemic productivity rose, may not be sustainable, may not be a wise thing. Maybe we have to watch it for another couple of years and see how it goes. And so while I think the ecosystem has been established for remote work, I don't think we have still come out with an adequate substitute for that face-to-face interaction.
While a consensus among the employers has not been reached regarding the work style they may adopt, a clearer picture will emerge when a majority of the employees return to office over the next few months.
Despite regulatory uncertainty, we hear a lot about cryptocurrencies and see a lot of activity taking place in that space. And Indian crypto startups are playing it big, advertising heavily and sponsoring Indian cricket competitions. It all seems a far cry from the situation we had in March last year when an effective ban on crypto in India was being considered. So what has changed to propel crypto in the mainstream in such a big way? And finally, considering crypto's growing popularity among millennials and the sector's employment potential, can the Indian government realistically look to completely ban or even partially ban the technology? Let's understand in this report.
Ahead of the winter session of Parliament, source-based media reports are again speculating that the pending bill to regulate cryptocurrencies will come up in this session. But unlike the reports in February this year, which was suggesting a complete ban on cryptocurrencies, A complete ban appears unlikely this time around. The reason, sources say, is that crypto in India has become too big for a ban. Too many people, around 20 million according to WazirX CEO Nishchal Shetty, have dipped their hands in virtual currencies. And India is being seen as the fastest growing crypto market in the world. The sector has spawned 2 unicorns already this year, CoinDCX and CoinSwitch Kuber. We are also seeing crypto exchanges beating digital stock brokers in terms of the user base. WazirX has 8.5 million users, CoinSwitch Kuber has 11 million. Both have more users than India's largest stockbroker Zerodha, which has 7 million users. It's amazing how much things have changed in a year. In March last year, the Supreme Court had quashed the RBI circular that barred banks from providing services to cryptocurrency exchanges. 1 year later, crypto companies are the toast of the town. Switch on the TV and you see ads hailing Bitcoin as a great investment instrument. Top Bollywood actors from Ranveer Singh to Ayushmann Khurrana are seen promoting CoinSwitch Kuber and CoinDCX respectively. Bollywood actors are launching the non-fungible tokens or NFTs, which are bought and sold using cryptocurrencies. According to industry estimates, Indians have invested around Rs 6 lakh crore cumulatively in crypto assets. Young investors in tier 2 and 3 cities who don't understand much about the stock market have taken a fancy to virtual currencies such as Bitcoin, Ethereum, Cardano and Solana. For CoinSwitch Kuber, which recently became a unicorn, the average age of over 11 million users is 25 years and 55% of its users are based in large cities like Delhi and Mumbai. For CoinDCX, the other crypto unicorn, 75% of its investors are aged between 20 and 34 years. The numbers have swelled too much for crypto to continue being unregulated. The Reserve Bank of India and the Securities and Exchange Board of India don't appear too keen to regulate cryptocurrency. So, the government seems to have worked out an alternative in the Gujarat International Finance Tech City or the GIFT City, according to reports. The centre may task the International Financial Services Centres Authority or IFSCA, based in Gandhinagar's GIFT City, with overseeing cryptocurrency trading. Remember, this is in line with what crypto exchanges have themselves proposed to the Finance Ministry in the past. The government is also considering levying GST on all transactions, including cryptos and NFTs, that happen over a blockchain. There are several other factors that have contributed to the industry becoming mainstream. Among Indian tech companies, crypto startups are hiring big. More than 50,000 professionals are working in the Indian crypto industry, and the sector is likely to create 30% more jobs in the coming months, according to a NASSCOM and WazirX report. Further, the total risk funding in Indian crypto and blockchain startups has touched over $587 million this year, compared with just $37 million in the previous year, according to industry tracker Traxon. However, despite this positive momentum for the Indian crypto industry, skeptics continue to advocate for a ban. Recently, the Rashtriya Swayamsevak Sangh or RSS chief Mohan Bhagwat, during his annual Vijayadashmi or Dashera speech, mentioned obscene images on OTT platforms, drugs and Bitcoin in the same breath, calling for urgent regulation for all three. On Bitcoin, he said it has the potential to destabilize economies. The RSS, the ideological parent of the ruling Bharatiya Janata Party, while not directly involved in policy making, uses the annual Dashera speech to spell out its firmed up position on policies that it feels the government should adopt. This year was the first time crypto figured in the RSS chief's speech. The government definitely has a tough balancing act on its hands.
Beauty e-tailer Nykaa share nearly doubled on the bourses yesterday as investors rushed to grab a piece of one of few profitable Indian startups. But if you're among those who didn't get the shares on the allotment and want to buy the stock, or you're wondering if you should book out on your holdings, watch our next report to find all the answers.
FSN E-commerce Ventures, the parent company of Nykaa, debuted in the stock market at 2018 rupees a piece yesterday, commanding a premium of 79% over its issue price of 1,125 rupees on the National Stock Exchange. Backed by strong investor interest, the shares scaled a high of 2,248 rupees, up 100% versus the issue price in the intraday trade. They, however, ended at 2,208 rupees, up 96% against the issue price. The strong debut also pushed Nykaa's market capitalization over 1 trillion rupees mark, placing it among the top 60 most valuable companies on the BSE. Meanwhile, Nykaa owner Falguni Nayar's net worth, who owns about half of Nykaa, swelled to $6.5 billion, courtesy the solid listing. Going forward, Vikas Jain, senior research analyst at Reliance Securities, suggests investors to partially book profit in the stock.
Nykaa had a super listing on the bourses with more than 95% gain at the end of the day. The company has been promoted by veteran investment bankers in the past, and we have seen a huge amount of uptick into the whole e-commerce chain. So we believe the stock would continue to see some more amount of uptick after the strong listing. But as the stock has already gained up more than 95% and have achieved the threshold limit of more than 1 lakh crore, so near the higher point of the range, so anything near to 2380, 2400 would be a good exit point for the share to put profits for the investors. Fresh investors should wait for some more clarity and for the quarterly earnings to gain an entry point, because if you look at the successful listings of Zomato, post its listing, the stock remains subdued for the later part of the weeks. So we believe the stock has a super listing, so the follow-up buying through would not be so great, as we have got huge amount of volumes on the listing day. So investors should book profit near to 2380, 2400 and wait for the next quarter results for a better entry point.
Jyoti Roy, DVP equity strategist at Angel One, on the other hand, suggests aggressive investors to hold the stock, while new investors may buy at current levels.
The Nykaa IPO had received a great response from investors and was subscribed 82 times, which translated to a blockbuster listing for the stock. The stock opened almost at close to an 80% premium, and as we speak today, it's trading at almost close to 100% premium to the issue price of rupees 1125. Now, the question is whether investors who have not been allotted shares in the IPO, should they buy at current levels or not. So, if we look at current levels, Nykaa is trading at a price to sales of 43x its FY 2021 revenues, which is at a discount to Zomato, which is trading at 54 times its FY 2021 revenues. And Zomato, as we know, is the leader in the food delivery space, while Nykaa is the market leader in the online beauty and fashion retailing space. And both these businesses have got a great runway for growth over the next 5 to 10 years. Therefore, given the significant valuation discount between Nykaa and Zomato, investors can look at buying into the current the stock at current prices of around 2200 rupees per share, because we believe that given that both are leader in the market in their own respective space, and both are going to have very strong growth over the next 5 to 10 years, we definitely do think that this kind of a discount for Nykaa is not warranted, and Nykaa should be trading at a similar valuations, if not at max a 10% kind of a discount to Zomato.
Overall, as Nykaa remains one of the few profitable startups in India belonging to the growing consumer internet space, analysts expect it to be one of the greatest growth stories over the next decade. However, it needs to deliver consistently on the bourses to justify the market exuberance. While for Thursday's session, volatility may remain high amid continuous foreign fund outflow and mixed corporate earnings. Besides, scheduled weekly expiry today will also lead to choppiness through the day. Overall, as stock-specific news flow, Q2 results and global cues will guide the sentiment in the secondary market. Investors are advised to maintain extra caution in the selection of stocks and focus more on risk management. In the primary market, public offers of Sapphire Foods and Latent View Analytics will be on investor radar today.
Have you heard of a stock or the stock market itself hitting the upper or lower circuit? What are these circuits and what happens if these circuits are hit? For how long is the trading halted? And why do we have these circuits anyway? We will answer all these questions in our next segment.
In markets, there are two types of circuit filters. One is at the stock level and the other is market-wide. In this explainer, we will focus on stock-level circuit filters. When a stock moves sharply in either direction, whether up or down, or reaches its maximum permissible tradable price level for a day, then it's said to have hit the circuit. In case of an upward movement, it hits the upper circuit, whereas in case of a fall, the stock hits the lower circuit. That takes us to the next question. Why do we have circuit filters? What are the various daily limits? A stock, depending on its category, can move by a maximum of 5%, 10%, or 20% on either side on any given trading day. Having said that, the maximum permissible limit for stocks are calculated on the basis of their previous day closing price on exchanges. Here's an interesting bit you should know. A stock which has hit the upper circuit cannot move any further higher on that day, but the stock can move lower in case there is fresh supply at a lower level than the circuit filter price. Similarly, in the case of the stock hitting the lower circuit, it can't fall further, but one can buy at the lower circuit since there will be plenty of sellers available. Why do stocks hit circuits? An individual stock may hit the circuit due to various reasons. For instance, in case of a positive news flow, there could be a high demand for the stock of a particular company and hence the stock may hit the upper circuit. Likewise, there could be an opposite scenario in case of an adverse news flow. Higher demand for shares than supply, upper circuit, higher supply of shares than demand, lower circuit. Who decides these circuit filters? The circuit filters are set by market regulator, Securities Exchange Board of India or SEBI, and revised on the basis of market volatility or any unusual activity in certain counters. These apart, the circuit filters are also revised periodically on the basis of market liquidity. Circuit filters are hiked for stocks with good liquidity. Circuit filters are lowered for illiquid stocks. The periodic adjustments are done to protect investors' interest in lesser-known stocks.
That's all we have for you today. We'll be back tomorrow with more news and analysis in our next episode. Stay tuned and thank you for watching.
If you liked this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.